Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. At our charity seminars of the last 2 weeks, one question was on everybody's lips. Are we returning to the 1970s? An oil price shock, a wage price spiral and stagflation, amplified by the tragic events in Ukraine. Then as now, we were coming out of the 1960s, a period of prolonged expansion, where low unemployment rates simply didn't seem to trigger a rise in inflation. Then everything changed in the 1970s. Inflation peaked at an extraordinary 27% for the retail price index in 1975, and UK interest rates rose to 17%. We suffered 2 punishing recessions, and oil prices rose tenfold. Now, thankfully, there are only faint echoes of the 1970s today, but I think they're worth analysing in the slides ahead and the implications they may have for policy and asset allocation. So let's begin by looking back at the 1970s in the first slide and remembering the extraordinary economic turmoil that went with that decade. The blue line is UK average weekly earnings, starting the period at a little over 5% and peaking at nearly 35% in the mid-1970s. The red line is UK retail price inflation, which similarly surged, but remained below wages for much of the period as a highly unionised workforce negotiated real wage increases. The green bars below are UK GDP. Look at those sharp dips negative in 73, 74 and 75 and in 79, 80. There's 2 punishing recessions that were accompanied by a surge in underlying oil prices. So reflecting on this, what are the messages today? What are the parallels and what are the differences? Well, on the next slide, the first question is, of course, that UK interest rates are far lower than they've ever been at any point effectively in history. On Thursday, we saw the third rate rise in the UK, taking rates to 0.75%. We expect them and US rates, which are on this chart, to peak at somewhere around 2.25% to 2.5% as the terminal rate. That is hugely different to the rates that we saw in the 1970s. Now, yes, this will be accompanied by quantitative tightening, the shrinking of central bank balance sheets, which didn't happen in the 70s. But all told, we expect the interest rate shock to be very much less marked and very much less dramatic than it was in the 1970s. Second, the oil price shock of the 1970s was of a wholly different magnitude to what we're seeing today. In the left-hand slide, I've shown the oil price from 1970 to 1982, rising from $3 to $4 to almost $37 at the end of the period, a tenfold or more rise. Compare that to the position today. I've shown the oil price on the eve of COVID at the beginning of 2020 and taken it up to the present day. Oil was about $65 at the beginning of the period and ended at $95 today. That's still a very large rise of over 50%, but nothing like the tenfold increase that we saw then. I've interestingly also plotted the price of Russian oil, that so-called Urals blend. Look at the difference opening between those 2 grades. $95 plays $69, the widest spread that we've seen, and a possible message that discounted Russian oil will be leaking around the world. The third key point is that the nature of global energy markets themselves has changed extraordinarily from the 1970s. If you look at the right-hand chart, I've shown US energy intensity. That's total energy consumption of the American economy per real dollar of GDP. In other words, how much energy do you use for any unit of growth? That's fallen extraordinarily as energy efficiency at all stages of the production chain in the auto industry and in homes and buildings has been transformed. It's fallen from around 14,000 in the 1970s to around 5,000 today. Secondly, of course, the impact of renewables is going to be huge. In the left-hand side from the new BP Energy Outlook 2022, I've shown the likely trajectory of energy usage. That green line, oil, falls away sharply from its dominant position in the 1970s to be overtaken aggressively by renewables and other energy sources. Fourthly, of course, the growth in global technology and Chinese manufacturing has radically altered the cost base of the underlying manufacturing sectors of the world economy and the service sectors relying on technology. On the left-hand side, I've shown the surge in NASDAQ since the 1970s and the extraordinary impact that's had on capital deployed towards the technology base. On the right-hand side, I've shown the phenomenal growth of Chinese foreign trade. Total export values negligible in the 1970s and extraordinary $3.4 trillion today. So the underlying deflationary forces of Chinese manufacturing power and growth of technology will help to keep prices in check this time round. One area though where there are some slightly disarming parallels is the labour markets, and I've shown here the UK number of employed people per vacancy, which we've seen in previous reports. As at today, there is one UK vacancy for every one unemployed person, a record I think, although this chart goes back to over 2000, probably that's not been seen in the past 100 years. On the right-hand side, you can see UK unemployment at 3.9%, now down below its pre-COVID level, and average weekly earnings beginning to grow. So the real pressure point and the parallel with the 1970s probably lies most strongly in the labour markets. So why are we reacting to this? What are we doing in policy terms? Well, first of all, we do think inflation is going to climb higher, interest rates are going to rise, and that's still a reason to be strongly underweight bond markets, which are so heavily distorted by government purchases over the last decade. We don't think, though, that inflation is going to be at a high enough level to really damage returns from equities. You still see this as a preferred asset. Yes, volatility is high, so we're neutrally based today, but particularly strong dividend growth continues to attract us to this asset class. What we really like, though, is alternatives. Yes, some gold to hedge against the Ukrainian crisis, but also renewables and infrastructure, where we can gain access to inflation plus income flows, the sort of hedges that were just not available in the 1970s. And finally, a prudent position in cash. We don't really know how this quantitative tightening is going to play out, or what effect it will have on markets, and of course we continue to have risks from the Ukrainian crisis. In all of this, as I said in our previous report, there's only one certainty. That's the continued bravery and fortitude of our Ukrainian friends, and once again our thoughts are with them. I hope you find this useful and the historic parallels valuable. Thank you.